what financial markets are all about, and also be able to take up the opportunities that are there. But it has been recognized that without financial education, this is almost impossible. So everybody needs to have at least some minimum levels of financial education. And what is motivating this government's approach, whereby they've even put in place national strategies, is the agenda for financial inclusion. So if we start from there, where we understand that financial inclusion is very important for any nation to become prosperous, and for any families to act, or individuals and families to actually be able to manage their financial welfare and affairs, then you get to understand that there's a lot that is going on out there, and by the government actually encouraging that everybody does get financially educated. So if I can just read for what it is, the National Financial Inclusion Strategy has the overall objective of providing the framework that will lead to the development of a stable, resilient, competitive, and inclusive financial sector that contributes to economic growth and broad-based wealth. So this growth and broad-based wealth is not sitting in abstract, it's actually with the people. The people are the ones that create wealth. So people must be able to really make decisions that help them become wealthy. And they can only do that through financial education. So that is how come then there was a subsidiary strategy formed to ensure that people can get financially educated. And at the moment, it might be of interest to know that financial education levels are quite low. They are improving because these interventions have been put in place for almost maybe going to 10 years now, these deliberate policies. So we are seeing an upward trajectory, which is quite good, but there's still a lot more to be done. And we're just really happy when we see people rally behind the various initiatives that are being put in place by the implementers. In this case being the regulators that we saw of the financial sector are co-implementers of these strategies. And there are also other, even non-governmental organizations that are also implementing these strategies. So the primary objective of their strategy, the NSFE, which is the National Strategy on Financial Education, is to empower Zambians with knowledge, understanding, skills, motivation, and confidence to help them to secure positive financial outcomes for themselves and their families. And of course, unless you understand some of these investing jargon or terminologies, we would most likely get intimidated when you meet with certain experts in the markets. For example, you want to invest in shares and they're talking about certain things that you really can't make anything out of it. Maybe they tell you about equity and so on, and you don't understand what that means. We are most likely to shun even taking up those products because you just can't trust what you don't know. So let's move, as we move on now, as we get into understanding these terminologies, I would like to just share a little about the capital markets. So when you hear about capital markets, of course, the simplest way to understand is that capital is really is money. Everybody does say on the streets that I need capital to do a business. I don't have capital to do this. So that capital really is, as it is talked about, it is money. And the market is a public place where buyers and sellers meet and make transactions, just like going a Soweto market, for example, any market, there's an exchange of money and goods. So the capital market, we expect that money is the good. the goods or the products that people want to are going to be using in terms of exchange. So capital market now put together is a market where buyers and sellers meet to buy or sell money or capital. Capital market is a market that facilitates investors to access long-term funding to finance long-term projects, where shares and bonds are bought and sold. Selling and buying is done through intermediaries. So in the capital market, there's the difference with the Soweto market is that there's a little more order. And this order is really because you're going to be doing business with people that you don't know. You're going to have to become a shareholder of a company whose management you probably have never met. You don't know them, it's difficult to trust. And therefore there has to be a lot more order. And behind the scenes, there's a lot of things taking place. And there's the regulator who has got rules to ensure that they are protecting the investors' interest. Like mentioned earlier, I did talk about the responsibility or the mandate or functions of the SEC as regulator is to ensure that it protects investors because of this very fact that it's quite a complex market that does not meet directly with whom it is doing business. There is intermediaries, there's the exchange, there's other fund managers who are busy bringing together the buyers and sellers. So there has to be a lot of order in that market. So who's an investor and who's an issuer? In the capital markets, you find terminologies such as investors, and the investor is simply you and me, or you and I. We also have, when I say you and I, we are bundled under individual investors. Then we do have investors that can come from abroad. These are called foreign investors. We do have institutional investors. These are institutions, usually pension funds, because there's a lot of money that is saved away under mandatory requirements. For example, if you are working, you are probably paying a pension to some pension fund. And this is a huge collection of funds that the ones who are running or managing that fund have to ensure that the fund is growing. So they will invest in somewhere. They will invest that money in certain instruments, which are really in the market. They are called securities, and these can include or are known as or bundled under equity or debt instruments. So equity is the shares or the stocks, and then the debt is the bonds, and so on. So we've already moved to the other side. On the one side, we have discussed the investors, and on the other side, we have the issuers. So issuers are the ones now that are selling the financial instruments so that they can actually raise funding for various purposes. And typically in the market, we have issuers who can be corporates, that is companies, and they obviously look to raising funds for long-term projects. And long-term in the capital market is anything beyond 1 year is typically categorized as long-term. And it is very suitable for projects that are long-term in nature. So these could be companies, and also government is a big player in the capital markets as it goes to market to raise funds that will obviously fund various government obligations such as social things, hospitals, for example, will build schools, and that requires a lot of money. That is why we find the government to be a very active player in the capital markets through the issuance of bonds. We also can have municipals. Municipals are just the local councils. The local authorities can also issue bonds, which are known as municipal bonds or subnational bonds, because we know that they have the mandate to develop their communities. And well, just to preempt, we are talking, the capital markets SEC as regulator is actually in discussions with municipalities to help them raise the funds that they need without really depending on the government treasury. We also have issuers which can come through projects like SPVs, which is special purpose vehicles. These could be specific projects that are put organized in such a way that they actually aim or do business, raise money, and also pay back to specifically develop that area. So these could be maybe government business, for example, toll gates, which are revenue, which have got revenue. So they can be used to raise money, you develop them further, and then that revenue is used to pay the investors. We also have issuers, which would be the small and medium enterprises. These have got special needs, and so they are not categorized under corporates. Of course, they are businesses, but they have their own special needs, and there's also means and ways that they can be helped to raise money from the capital markets. So how can you benefit from the capital markets? So what are the investment options in the capital markets for you? So we have the shares, the bonds, collective investment schemes, or unit trusts that an investor can actually invest in. And for shares, we know that these you become a part owner of a company when you buy shares, and you can benefit from these through dividends or capital gains. These will be explained in detail as we go on. And you can also invest in bonds. There's a lot of talk around investing in bonds. When you invest in bond, you are simply lending your money to the issuer, it could be a government bond, it could be a municipal bond, or a corporate bond by the companies as just discussed. Or you could want a more passive investment. You are perhaps risk averse, or you really don't know how to invest in shares or bonds, or you think you don't have enough to do that, or for just having another asset class. You can actually invest in what are known as collective investment schemes. They could also be used as your savings. They're easy for that because you don't need too much money. You can try and grow your money through a collective investment schemes, which is a pool of funds that is put together by a fund manager. Of course, this fund manager is not just a person; it's a company. It will have a name. It could be different names, and if you are interested, you can look them up on our SEC website. And I'm sure some of them are in the marketing. You may have heard about unit trusts and collective investment schemes. So this, you pool your money together with other investors, and when the fund manager collects that money, they will onward invest in different assets like shares or bonds or even property. And so the jargon you find with the CIS is probably they'll be asking you to choose which asset or which fund to invest in. And you may find that there's a balanced fund, which means that there's bits of everything. Maybe that balanced fund is actually having assets in different kinds of asset classes, such as bonds, shares, property. There's a mix of it, so it sort of balances your investment risk. Or it could be an equity fund, meaning that they are investing in shares or equity. Or it could be a foreign, meaning a foreign fund, or they do have their terminologies, which they'll indicate that you probably are investing in assets that are based abroad. So it will be earning in your maybe US dollar fund and so on. US dollar currency, foreign currency, obviously, most likely to be US dollars. There's an advert there, which is just there to give us a breather, future financial well-being. This is almost a must, and everybody must begin. And I'd like to preempt that the B in the ABCs can just as well mean begin now. The best time you need to begin investing is yesterday. And if you are not already begun, you can begin today. Because with investing, time is your best friend. And remember, we're talking long-term funding in the capital market, long-term investing in the capital markets to be really what is on your side, because of the so many ways that time works for you. So we encouraging you to invest in products of the capital markets. The capital markets offers you investment opportunities in products such as the shares, bonds, and unit trusts. Okay, now we move to the ABCs of investing. So the ABCs of investing refer to the fundamental principles and concepts that individuals should be aware of when it comes to investing their money. Understanding these basics can help beginners build a strong foundation for their investment journey. It was mentioned earlier, I think I did mention that as you begin your journey of investing, you will be met with way too many terminologies, and some of them could be, you could get discouraged if you don't know what it means. So knowledge is critical. You need to get interested in understanding what they mean. And hopefully, as we go now, delve into the ABCs of investing, we will actually sort of unbundle what some of these terminologies or jargon that you might come across really mean. So we start with A, and A, we have picked assets. There could be many other A's, obviously. But in capital markets, you will not go around without talking about assets. I probably talked about assets already. And so assets are the items or holdings that you invest in, such as stocks, bonds, it could be real estate, mutual funds or commodities. Each asset class has its own risk and return characteristics. And a diversified portfolio typically contains a mix of different assets to spread the risk. I mentioned, I think just before now, how collective investment schemes will help you diversify. How a fund manager will use this strategy in a balanced portfolio to spread the risk, but the risk that they are really looking at is they are trying to ensure that you don't lose out as a unit holder. You still have your money making some profit of sorts in case some of the asset classes did actually have a bad time in the market. For yourself, a diversified portfolio obviously will mean that you invest in different products. You have a bit, some money in a different asset class, like put up here. You can have some money, you could have some property, even the CIS and so on. So basically, the diversification will really mean do not put your eggs in one basket. Then B for bonds. Bonds are debt securities issued by governments, municipalities, corporations to raise capital. I think I have already explained, belabored on this point already. So just know that your bonds are debt securities, which is simply lending your money to the one who's issuing these bonds. And the ones who are issuing are really trying to raise money from the public through the instrument of debt, through a debt instrument, which is called a bond. So when you invest in bonds, you are essentially lending money to the issuer in exchange for periodic interest payments. That is, you might be thinking, what is in it for me when I buy a bond? So you're going to be earning interest payments, also known as coupons. And then you also get your principal amount at maturity. So the bonds have tenors, what are known as tenors, which is the period of the time that the bond will be in the market. Maybe it's a 2-year bond. Of course, it has to be beyond 1 year. As said earlier, all instruments in the capital markets are beyond 1 year. So the bond will typically start at 2 years. You can have it, you will find a bond which runs for 3 years, 5 years, 7 years, 10 years, and 15 years, if we are talking government bonds. So this is long-term. It would be now up to you as an investor to choose which one suits your investment objectives. We go on to see compounding is a very interesting concept in the investing world. It is very powerful and everybody talks about it. So compounding is a powerful concept in investing. It refers to the ability of an asset to generate earnings, and those earnings in turn generate their own earnings. And over time, this can lead to exponential growth, investment value. So this is where you have earned your interest. For example, in the bonds, if you have invested in a bond, you earn a coupon or interest basically. Then you use that interest to add it back into the investment, and it starts earning interest. And over time, you find that you are now using interest earnings to earn more interest. In fact, you add, if it's savings, typically you add to your principal, you add the interest to the principal and roll it over. So you have more money, and over time, you earn more money than you would have earned if you had just been investing the principal or just the interest on its own. So compounding is a very powerful concept. And again, time is your best friend when you are onto this compounding strategy. You need to start early, and you'll find that you will have reached your objective, if that is what it is, to earn a certain amount of money over a certain period of time using this strategy. Diversification for D. So diversification involves spreading your investments across various assets, industries, and geographic regions. This helps to reduce the impact of any single investment's poor performance on your overall portfolio. We did talk about it. It's really not putting your eggs in one basket, because the products that you invest in will perform differently due to many factors that are in the environment. So you could find that a certain sector, even with shares, for example, there are different companies that may be listed on the market or on the exchange, but are all doing very different things. For example, we have the breweries, which are obviously in their own sector. We can have companies that are in the construction sector. We have others, maybe to do with some environmental issues, the environmental sector, or fast-moving consumer goods, tourism, and so on, agriculture, and so on. So those are different sectors, and they perform differently. And you might find that in any one significant period, you have maybe one of the sectors doing very badly. For example, we saw in the COVID period how tourism really nosedived. It was really bad in that area. And if you were invested in that sector, or in a company that was in that sector, you would expect that you you won't see much out of your investments. But on the opposite, you may be in the you may have been in the pharmaceutical sector, where we saw a rise in the demand for pharmaceutical products, the medicines and other supplies. So you expect that industry or sector really performed very well, and therefore the profits were good, and your dividend is likely to mirror that that growth that was there. So you'll probably be getting more money during that. So your diversification will correspond to what is happening in the different assets that you have invested in. A saying from Albert Einstein, he says, it's a famous saying, and he says compound interest is the eighth wonder of the world. And while that might seem like an exaggeration, that quote could not be more true in finance. So imagine it's the eighth wonder of the world. So it's important to know how you can use it. It's important to read. I would encourage that you read about it and find out how you can use the numbers to actually do your compounding and understand where it can get you. Equity, we talked about equity, simply represents ownership in a company. I can give an example that if you hold 100% equity, it means that you are actually the sole owner of that company. So it just represents your interest in terms of ownership in that company. When you are you own shares, you are a shareholder. You have equity interest in that company. So we can go to F. F is financial goals. Before investing, it's encouraged that you define your financial goals. What do you want to invest in, or what do you want to invest for? Are you saving for retirement, buying a house, funding your child's education? What are some of those things that you want to achieve out of your money over time? And once you establish your financial goals, you will know where to invest, which instrument in the market are available that can help you substantially meet those financial goals. G is for growth versus value. You won't go around again in the capital markets without thinking growth. What is the value? Growth and value are two common investment styles. Growth investing focuses on companies with strong potential for revenue and earnings, while value investing looks for undervalued company with solid fundamentals. So you know that when you're speaking, by the way, when you're investing in companies, you will meet with an intermediary who's called as a stockbroker. So within the knowledge that you know that I have to, with having established your financial goals, you might be saying, I want a company that is growing or which has strong fundamentals, meaning that the company with strong fundamentals, solid fundamentals, will obviously stay in the market, will probably be in its maturity, will always earn you a dividend. A growing company, which is your growth strategy, will ensure that your shares will earn what are known as capital gains, will grow in value, most likely over the period you are holding them. And you might also want to relate this to what is known as or before we go there, we talk about holding period, which is the H. The holding period is the length of time an investor owns a particular investment. The holding period affects the capital gains or losses that the investor realizes from the transaction. So there's also what is known as that supports that or explains the holding period. People talk about time in the market. There's discussions around time in the market, which is a phrase That refers to the concept that the longer an investor holds onto their investments, the more likely they are to achieve positive investment returns. So it's not, the opposite of it is timing the market. Those who time the market are more or less speculators. They sort of have that strategy to only buy or sell at a time when they think that the price will probably go up, or there will be some advantage to them like that. So it's kind of a risky strategy, and it requires a lot of expertise. And so investors are advised to spend time in the market for them to see value. And if they did their investigations, or they did their background checks on companies, and they found that these companies have solid fundamentals, even if the price went down in the short term, it's more likely that it will to have an upward trajectory in future or over the period, over time. You also might come across what are known as index funds, which is and index funds are mutual funds or exchange traded funds, which actually we hope to see introduced in our market very soon. Jargon, J for jargon, some of them obviously are just there to explain what we're doing. The jargon is the investment world has its share of jargon and technical terms, and this is some of them we are trying to break down or dissect and understand what they really mean. Knowledge, educate yourself about investing before diving in. Read books, take courses, and stay informed about financial markets and economic trends. Long-term perspective, what does it mean? A broker or an investment advisor will talk about long-term perspective. They'll probably say over time, over the long term. So what that means is investing is generally more effective when approached with a long-term perspective. It allows you to ride out market fluctuations and benefit from compounding. Remember I said with compounding, time is your best friend. Market volatility, for M, markets can be volatile. There's always a disclaimer, even as you invest, that prices may fall or may rise or fall because of volatility that is affecting the markets. So it's simply talking about fluctuations that can happen sometimes frequently and sometimes maybe not. So it's crucial to stay patient and not make impulsive decisions during market downturns. There's also something around this topic which talks about your emotions. When you're investing, you really need to check what emotions you have around the money you're holding or you're trying to put in your investments. If, for example, you need that money or you are risk averse, you might not want to put in an investment that is likely to be volatile, because that will really be bad for you, even for your health, when you think about it. Because you see, maybe in the short term, the price falls, and you can already calculate the losses. It might really not be good for you. Or you have invested in a fixed account when you need your money in the short term. You fixed your money in a long-term instrument. Maybe 5 years is when after 5 years is when you can access your money. Meanwhile, you need those funds from time to time, or you don't have any other source. So that can be quite not a very good strategy in terms of investing. Net worth. To figure out your net worth, you need to add up your assets. The cash that you have in your bank accounts, investments that you have, the property you have, what's the pension that you have, and then you need to know the value of all that. If, for example, we're talking property, you need to understand the value of your property so that you can add it to the more obvious instruments, which include cash and so on. Okay, so I think I've just checked my time. I will try to cruise through so that we can try and finish.
Have
We've talked.
at least 5 more minutes so that
Okay,
we can
okay.
get into a Q&A.
Yeah. So when you understand your net worth, you know where you've been spending your money, and you want to sit down and assess where to take your money next. You're tracking your financial progress over time. There's things like opportunity cost of portfolio. I think we've talked about that. Opportunity cost, obviously, is what you have forgone by choosing one investment over the other. It's important to understand these things. A portfolio is a collection of your investments. It could be your cash, your property, or your in the different asset classes. It should align with your financial goals and risk tolerance, like we have discussed. Qualitative and quantitative analysis, these are things that will be done to assess performance of your investments. We have, I think, let me go to risk tolerance. I think we've talked about this risk tolerance already. And it will advise what investment or what instruments you should be going for, depending on your risk tolerance, or also what is known as risk appetite. Stocks, we have talked about them. They represent ownership in the company. And time in the market, we've talked about time in the market, which is advice that's best to stay in the market and not you timing the market unless you really understand what you are doing or how to do it. So if you're a shareholder, you own stocks, you need to know that you're part of that company. It's another S for the S, we had two there. Understanding the fees is very important. You need to ask what are the fees and how will they impact your investment. We've talked about volatility, wealth management. As your investment grows, you may consider working with a financial advisor or wealth manager to optimize your portfolio and financial strategies. And as you do that, ensure this is your money, it is hard-earned money, ensure that you are approaching a SEC licensed investment advisor. So part of the ways that the Securities and Exchange Commission, as regulator of the capital markets, protects you is by checking those people who are working as investment advisors. They are checked for various things and to ensure that they are actually meaning well for you as an investor. There's what is known as xenophobia, just to take care of the X. It's really global diversification. Investing only in your country may pose you with certain risks that are geographic in nature, that relate to the geography or your country. Maybe there's war and so on. So you might consider global diversification of your money if you are in such a turbulent geographic area. Then you also are able to access a broader range of markets and economies. In some countries, they are really doing fine and they just have it going on. So you might want to benefit from what is happening there. And with globalization, we are not really limited to invest. And the yield is the income generated by an investment, such as dividend yield from stocks or interest yield from bonds. So remember I said interest from bonds is also called a yield. It must not intimidate us when we hear such things as yield and so on. Then the Z of investing is a path. The Zen is called the Zen of investing. It's just trying to help us know that what you have is enough. It's not a competition when you are investing. You have to do it at your own pace and be content with what you have. And that should brings me to the end of the ABCs of investing. They've taken a bit long, so I'll very quickly, I don't know whether we should have maybe separated these presentations, but very quickly, as you are investing, you have rights as an investor and you have obligations. Remember, obligations are really just the things you need to do. You have the rights, yes, the right to information, you right to transparency, and that is what the SEC ensures that those who are providing you the investment products or securities are actually giving you all the information that you need to make your investment decision. And even as you transact with your brokers, they need to give you things like receipts. They need to really understand your investment objectives. So they give you all the information also that you need even on the performance of companies to help you make the right investment decisions. And you have the right to fair treatment and so on. And also the right to redress. You need to complain if you're not happy to them, and if you're not, you can still come to the SEC. Those are your rights. Obligations, I really did talk about them. I said they're the things you have to do. To earn a right, you have to do something also. It's a give and take. You need to do your due diligence. Don't just accept anything that somebody says is good. Do your research. You need to comply as an investor. Disclosure, invest as much as possible. For somebody to invest, to advise you rightly or correctly, they need to know a lot of things. So you need to disclose relevant information to financial advisors when engaging in investment activities. Otherwise, they will misadvise you and you might end up buying a wrong financial product. Risk acceptance, investors must accept the risk associated with their investments. That's why they make us sign somewhere sometimes, or most times, or all the time, when there are always those terms and conditions, and they'll make you sign for them because there's no one investment which comes with no risk. So you have to accept the risk, understand and accept to sign. If you don't sign, you might not even be sold that product. And I think that should reach us to the conclusion. Specific rights and obligations of an investor can vary significantly based on the type of investment. Therefore, it's advisable for investors to seek professional advice and educate themselves about the specific rules and regulations that apply to their investments. And happy to come to an end.
Okay, wow, that's a very elaborate presentation, Dingase. Very informative. I'm sure audience has learned a lot, and it was very, very interesting. We have a number of questions that have come through. Dingase, you did speak about compound interest in your presentation. So we have a question regarding compound interest. One attendee says, when it comes to compound interest, am I able to invest my coupon on the bond as opposed to getting it when it falls due? So let's say after 5 years, my investment is great.
Yeah, so with bonds, they are fixed term. You will not be able to reinvest your coupon in the same instrument, but you need to look for other instruments that that will help you to reinvest your interest, to compound your interest. For example, there's more short-term instruments, or even the unit trusts. So if you get your coupon, obviously every 6 months, you can get that coupon and put it in a fixed deposit for 6 months. And okay, once it matures, you can again, now you can be timing your other your other investment products or how you actually compound that interest. For example, if it's 2 years, you can actually invest even in a treasury bill. It's another security on the market for 1 year, and again compound it in another one, and it meets with the term, the maturity of your bond at 2 years. And then you can, if you're in there long term, you don't want to use that money, you can now put the money together and again reinvest. That's where you are still compounding. So yeah, it won't allow you to put it back. It's fixed, it's closed, but you can still use other strategies to compound that interest.
Okay, thank you so much, Dingase, for that response. I think it actually answers Patricia's question, who was asking on whether she could compound a payment on a bond, and you've taken it, you've handled it very well. in that this person can put it in another instrument.
Mhm.
And then we also have another question from anonymous attendee. Is there a minimum amount to buying bonds? They would like to find out.
Yes, there is. There's at the moment, if we're talking government bonds, it's 1,000 kwacha.
Okay. And then for people who do not have a stable income, what would you advise them to invest in? So for instance, as a student who gets money, let's say once or after a number of months, are there opportunities that they can invest in?
Yes, of course, there are the collective investment schemes. Don't limit you to investing at a particular time. You can invest as many times as possible. The only restriction that they might give you is in terms of redemptions. Redemption also meaning withdrawals, especially for the first 6 months when you are with the collective investment schemes, because they want you to see how they work. They don't want you to go in as if it's just as any other savings account. This is an investment account. So they would like you to observe and know how it works. So the first 6 months, most of them will ask you not to draw out. But I'm sure if you are really pressed, you can talk to your fund manager and they can allow you, maybe penalize you, I don't know, I'm not sure. But in terms of putting in money as many times as possible, you can. That's why we actually market it or talk about it or are proud of it as a very good investment account, which can also be used like a savings account.
Okay, so
But
speaking
of
of
course, earning much more money, much more
yeah,
interesting.
okay. Okay, so Dingase, so speaking of collective investment schemes,
Mhm.
is there an example of a unit trust that you could give us? Or maybe could you list the unit trust that we have available for our audience?
I'm not so sure I can do that as coming from a regulator. If I mention one or two, because I've forgotten the others, it might be misconstrued as supporting those which I've mentioned. But I can encourage everyone to go to our website and look for the list of the unit trusts. Yeah. And then you don't just, of course, go in with closed eyes. You need to really ask your questions, do your shopping. They have different strategies. Check the fees that they have, compare, ask as many questions as possible. Remember, information is your right. So it does not matter how, don't feel intimidated or feel you can even speak in your local language. They must answer to you. Find out as much as possible until you are really satisfied that this is what can work for you.
Okay, thank you so much, Dingase, for the responses. We also have another question. What are the interest rates on government bonds?
They are different depending on the tenors. And again, the Bank of Zambia, which is the ones that are running the government bonds, have a lot of information on their website. If you go to their website, you look for government securities, they will give all the information you're looking for in terms of interest rates. They are different across the tenors, with the highest around 27% at the moment on the 15-year bond, and the 10-year around a similar amount, 7 years somewhere. The more time in the market, remember we've been talking about time in the market, the more the likely you're going to have a higher rate. But of course, because of many other fundamentals, maybe taking into account the inflation and so on, the impact of inflation on investment, yeah.
Okay, thank you, Dingase, for that. Then we also have another question. Do we have international mutual funds we can invest in as individuals?
On the market, we do have players who can access you to foreign funds, yeah. And I think most fund managers also have a fund where they access international markets. Yeah. Again, I don't want to really mention these companies, but if you checked in on our website, you will find some, and you did your shopping, you can find some. Yes. So the answer is yes.
Yes. Okay. Thank you for that. And then just to inform the audience that we will share this presentation. Most of you did receive our email for invitation to the meeting, so we will share the presentation to you via email. If you did not receive this invitation by email, you received it, let's say on WhatsApp, you can still share your email address in the chat. Then we'll gather the emails there and share the presentation.
Yeah.
Okay. I don't see any other questions from my end. Oh, just one more. What is the procedure to follow if you are absolutely new to investing? Is everything on the SEC website, or should we visit the SEC offices?
Procedure. Things we've been talking about, you need to first start by understanding your investment objectives. What do you want to invest for? And then you need to understand your asset, your standing. What is your net worth? I don't know. Did we discuss net worth? Yeah. You need to understand your net worth by understanding what assets you have and what you're owing. Because that nets off. If you are so much in debt, you might want to get into a strategy where you pay off most of your debt, and then you can have you can have some funds that can be locked away. Remember, investing is in terms of putting money away for some time. So you need to have a positive net worth, more or less, when you're undergoing it. By the way, we need to share, maybe someone can share, or we'll share as we share the presentation. We have what is known as the SEC guide to investing, to saving and investing. It will explain all these things that you have asked. So once you understand your net worth, it also shows you where you've been spending your money. And if it hasn't been very good, you want to know that you want to find other ways of spending your money or investing your money. Yeah, so you need all those considerations. For how long? What is your risk appetite also? Are you also your age? It matters also. Because your risk appetite or investment strategy will depend on also your needs. Age is one of them. If you are a senior citizen, you will not be investing. It will not be wise to invest in very risky instruments. For example, in case you lose big, and you are unlikely to recover. Before you can, at least if you are young, you can take your chances. You are most likely to recover and learn from the lessons and do better. So there are a lot of things, and actually the investment advisors are really skilled professionals who take you through this journey. As you are, if you really don't understand how to go about it, your best option is to approach an investment advisor. Now you might be asking, where can I find an investment advisor, and how much will they charge? If, for example, you go to a brokerage company, stockbrokers, you want to invest in shares, the person who's going to be talking to you is most likely a certified investment advisor. Or if you go to a fund manager, you want to invest in the unit trusts or the collective investment schemes, most likely, and it's a requirement by the SEC that the person who talks to you is a certified investment advisor. So you have to just take advantage, because whether you end up buying into their fund or not, or buying stocks, you can actually come out with a lot of benefit already having discussed with that person, because they'll be asking you a lot of questions. They'll tell you this and that. Are you sure you would like to invest in breweries? Some people, just based on moral aspects, they'll say, no beer for me. I won't support those things. So they'll establish a number of things. And of course, I said your age matters a lot, your risk appetite, your investment horizon, so to say, is how long do you have to go to meet your investment objectives.
Okay, thank you so much, Dingase, for the responses. One last question. Patricia wanted to know about the new product that the SEC is offering in the market, introducing on the market. New products. What new products are SEC offering on the market?
So SEC doesn't offer products, but it will encourage the offerings by putting in place certain regulations around the same products. It is also part of our market development mandate to ensure that there's introduction, all these diversified products on the market. So and products are regulated. There's, for any company to come in the market and offer products, they are authorized to do that. They are authorized or licensed to actually do that business. So what the market does, what the Securities and Exchange does as regulator is, and for us sort of to set the rules for which we are going, to which we are going to actually regulate those companies, we put in place regulations and rules and guidelines and so on. And so right now, we are actually running with what is known as a Capital Markets Master Plan, which is, we basically look at developing the market in a way that should serve different interests of investors. Because at the moment, the products classes are very few. We have the equity or the stocks, the bonds, the collective investment schemes, and that's all. And then you find that in other markets, they have the exchange-traded funds, they have actively going on what is known as real estate investment trusts, which are all versions of collective investment schemes. But you find that maybe they are less risky, like the exchange-traded funds. They are less risky, they are passive investments, or you can almost sleep very peacefully when you invest in an exchange-traded fund, for example. And we already have introduced, we have already developed guidelines, although we still don't have the products on the market. So what we do, we develop the guidelines, and then we engage the markets and encourage them to develop and offer to the public such products. And only yesterday we had a workshop where the ETFs, which is the exchange-traded funds, were actually being put into force. Because we want to have the regulations gazetted. That way, we can have different companies who are interested in offering those products, even if they are going to come from another jurisdiction. At least they will have found regulations. So these would be the new products I can talk about, the ETFs, and that we are really hoping that they will be taken up. The market will take them up and offer them to the public very soon.
Okay. Thank you so much, Dingase, for the responses and also the presentation. We have come to the end of our town hall. The town hall is meant to be a discussion for just an hour. I know it's quite interesting, a topic, in capital markets. So we do get a lot of questions, but what we've done is, as I mentioned in the beginning, the town hall takes place every last Thursday of the month. So you're able to join us next month again for another interesting topic. And then also we will be at the Lusaka Agriculture and Commercial Show exhibiting there. So please feel free to visit our stand and interact more with us. Thank you so much for everybody that joined us. We'll see you again next time.
Thank you, Stella.
Dingase, we can't get you. You've muted yourself.
Oh, sorry. I'm actually talking to Comfort here. Thank you.